Welcome back. Today we're going to consider auto sales as it represents such a large part of the U.S. economy. We're going to look at the total number of new and used vehicles sold and the actual sales dollars, the amount of dollars that changes hands by month. We're going to take a look at this in respect to the S&P 500, the federal funds rate, and also individual stocks. We're also going to discuss the new and used ratio, the ratio of new cars versus used cars, and see what differences they have there. So first off, the S&P 500 is in red. This goes back to 2002. The blue line represents the total sales of used cars. Now this is in dollars, so we're looking over almost $1 billion at one point. We can see a very strong correlation. In fact, we're going to see in a moment the used cars, the sales numbers of used cars has in fact the strongest correlation to the S&P 500. Over time, as stocks go up, the total amount of used cars goes up, which may be, may cause some question, as we would think the stock market, companies like Ford would benefit from the sale of new cars, but it's actually the number of used cars and the dollar amount of used cars that has the strongest correlation to the stock market. Here we see the different correlations. On the left-hand side, we have the S&P 500 has a negative 19% correlation to the number of new cars. Negative 4% correlation, really no correlation. When the number's close to zero, positive or negative, it means there's very little connection. But there is a 55% positive correlation in the total number of dollars of new sales. The number of sales in terms of dollar-wise to the S&P 500, 81% to used total sales as well. The Ford stock trading the S&P 500 has a 48% positive correlation to the S&P 500, which does make sense as Ford is in the S&P 500. And the federal funds rate has a 40% correlation to the S&P 500, which also makes sense to some extent as stronger economies, we tend to see higher interest rates historically. Now, new cars has a very strong correlation to used cars. That's not a question there at all. Notice there's also the total sales of used cars in terms of dollars has a 51% correlation to the federal funds rates. But we're going to see in a moment higher interest rates are actually a negative over the long term. Here we see the total sales of used cars, the S&P 500. Most recently, we hit highs December 2021. That's for the stock market. Very strong correlation as the S&P 500 has gone down since then. So does total sales of used cars. Now, we take a look at the new-used ratio in blue. That is the total number of new cars divided by the total number of used cars. When the line goes higher, we see more new cars are sold rather than new used cars. Conversely, when the line goes down, when this blue area chart goes down, it means more used cars are sold. Now, take a look at the lows, 2008, 2009. We know the stock market went through a very big correction at that point. S&P 500 in red went down quite a bit, and more people bought used cars, comparatively speaking, than new cars, for obvious reasons. Conversely, as the stock market began to rise, we also saw the number of new cars sold. However, the ratio has pulled back. We'll see in a moment. Maybe that's the result of higher interest rates. We had zero interest rates in 2015, around that area. But over the past couple of years, we know interest rates have gone up quite a bit. Maybe that's one of the reasons why the new-used car ratio has not recovered. Here's the new-used ratio and federal funds. The federal funds rate is the red line. We know we've gone up over 500 or around 500 basis points in the past year or so. And we can see historically over time, when interest rates were very low, like in 2015, the new-used ratio is very high. Well, it's very logical. Zero interest rates or very low interest rates make it a lot less expensive to buy a new car. So if we want a car and interest rates are very low, it makes more sense to buy a new car. Conversely, when interest rates are high, the new-used ratio falls. So certainly this is a very logical chart. We have here the new-used ratio, and the red line represents Ford, traded obviously on the New York Stock Exchange. Now, this is not necessarily a stock recommendation, but more to demonstrate Ford is, the largest truck maker, one of the biggest components in automotive history, and we can see that more over time. We can see, for example, 2015, the new used ratio was very high, around 65% or so. And Ford stock was reaching near its highs as well. Conversely, as a new used ratio has continued to decline between 2015 to 2020, well, Ford stock went down as well. Now, we obviously saw a huge recovery in the new used ratio and Ford stock. That's post-pandemic recovery with that's came along with very low interest rates. Maybe that's one of the reasons why Ford stock did so well. But now the new used ratio has begun to fall, and so does Ford stock as well. And then finally, we can see over here, the red line represents Ford, and the blue line represents the federal funds rates. Low interest rates tend to bode very well for automotive dealerships, automotive manufacturers like Ford. When interest rates go up, well, we tend to see the stock market go down, and especially those interest rate sensitive industries. Now, of course, Ford had a huge move up as a result of very low interest rates. But as interest rates have continued to climb over the past year or so, Ford stock is under more and more pressure. So there's very clear and very logical correlations here that the overall auto sales, we tend to see more new cars purchased under low interest rate environments. That tends to bode better for auto manufacturers like Ford and General Motors, for example. So it's really, it's logical, but I think it's important to make note of where the new used ratio is, as well as the overall state of the automotive industry, because not only, is it so predictable in terms of interest rates and the overall tone of the economy, but also it can help us really position into what would be either a good investment or bad investment. Now, conversely, when interest rates are very high, maybe that does lead to an opportunity, to buy the stock after it's come down quite a bit. Taking into consideration the current climate with very high interest rates, we would expect Ford stock to be under pressure. Maybe after some period of capitulation, maybe it will represent, some value for us. We're going to continue to watch these numbers and many others. We have a big week of economic numbers this week as well. So stay tuned, and we hope this has been helpful. We look forward to seeing you back soon.